Lithium-ion Rocks, Season 1, Episode 2. We are recording this on January 27th, Australia Day. By the time you're listening to this in Oz, happy belated Australia Day. And in China and elsewhere where the Lunar New Year is celebrated beginning the 28th of January, I wish you a happy Year of the Pig and a happy goodbye to the Year of the Lithium Dog. I would encourage you to listen to the very end of this Lithium-ion Rocks podcast because we have a special long-distance dedication to a particularly interesting black dog. I published the Lithium-ion Bull yesterday, and included in that is a new and improved Mr. Market scoreboard, which I would encourage you to look at. The title is Lithium Go Green. And up from 10 names I mentioned in October, I've added 3, so we now have a baker's dozen that are in focus. In addition, I put a column for cash balances, which highlight those companies who have meaningful amounts of cash, and highlighted in red those whose cash balances are $5 million and below. The Lithium-ion Bull and the Lithium-ion Rocks should be read and listened to in tandem. There's a fair bit of information that won't be discussed in detail in the Lithium-ion Bull that Rodney and I will discuss here, and vice versa. And feel free, there's an email of both of us, and you could follow us on Twitter at HowardKlein10 and at RodneyHooper13. Please feel free to reach out if you have any questions or comment. I'd also like to draw your attention to the disclaimer at the very end of this podcast. All right, Rodney, we're going to talk now about your great note, which you published on LinkedIn over the weekend, labeling Ganfeng as one of your top picks. It's mine too, but why don't we go through your investment case, and I'll ask you a few questions along the way.
I have 4 main reasons why I'm keen on Ganfeng, not least of which, a fifth would be simply that the price is so low. But the 4 main investment pillars for Ganfeng, the first one being volume growth. We're seeing an incredible expansion of their production of both carbonate and hydroxide over the next couple of years, pretty much industry leading. The second point ties into the first point is the capital intensity of that volume growth is really quite exceptional, with particularly in the hydroxide side, where the cost of capital per installed ton of capacity is sub $3,000. They're forecasting it to be $2,700, so even if they're slightly off, it's an unbelievably low number. The third point is improved transparency. Ganfeng did the Hong Kong listing. They have now employed Sam Pigott in Canada, so it's likely that we're going to get far better input and insight into what's happening with Ganfeng out of the Hong Kong listing. And then the final, fourth pillar is the spodumene price is falling. I wouldn't necessarily say falling, but what you're seeing now is the new contracts with the new suppliers outside of Mount Marion agreeing to contracts which are much more closely tied to the price of Ganfeng's product mix, where the company is better insured to earn a decent margin. And even then, using industry averages, because of the quality of Ganfeng's management team and production team, they're likely to earn additional margins above the average. So those are the 4 pillars: volume growth, the cost of capital intensity to grow that volume growth, improved transparency, and new spodumene offtake contracts that better allow it to lock in and have some operational gearing on margins.
Sounds good. And they've been extremely busy since their IPO, right? Making a couple of transactions. Why don't you talk about those?
Sure. They executed the LAC deal, taking over SQM's position, and they did it on good financial terms. It is still slightly early days, but LAC is under construction. I haven't done any major forecasting yet on production, but regardless, they certainly didn't, I don't think, overpay for their position in that transaction. Then we saw Altura, an offtake contract. A few things happened on Altura's side that they ended up needing a new offtake partner, and again, not overly detailed, the announcements from either side, but I would think very much like Pilbara, and possibly even better terms, where Ganfeng will be able to lock in and secure a decent operating margin relative to what they pay for the spodumene. And then a further investment to help secure Pilbara to help secure their stage 2 expansion. They've underpinned a 50 million Aussie equity raise. The pricing, as I understood it, was about 64 cents, which again, considering what we think of Pilbara, I thought they got a very good deal there as well.
Okay, that's great. So very busy since raising that $400 million. Quite a bit of it's been committed. In addition, they are a lender to LAC, so there are capital calls they're going to have to give for the Kachari construction. You also talked about the broader industry overview that is benefiting Ganfeng. Why don't you talk about that a bit?
What we've seen of late in China is a shift in their subsidy policy, and they have certainly now favored EVs with longer range and batteries with higher energy density. So what's happened is effectively the industry can build better performing cars, and on an after subsidy basis it doesn't cost the consumer any more. So what we've seen is a migration in the size of the battery pack of cars, and that's pushed out, and now potentially, especially with the inclusion of Tesla into the China market, you could see the average kilowatt hour size drift out to 55, up from where it is now, around 50 or less. So that's very helpful.
That's an important point, Rodney. I remember hearing Anthony C. Talking about just an increase from 50 kilowatt hour average to 55 kilowatt hour means a very significant increase in LCE, even without an increased EV penetration rate.
Yeah, so you're getting a huge benefit. So you're going to get both the percentage growth in sales and the battery sizes. So he's correct. It is positive certainly for the Chinese market.
Why do you think Ganfeng's price fell so much?
Yeah, Ganfeng, it's amazing to think back to late 2017, early 2018, when the share price in China hit nearly 70 renminbi, and it had a market cap of slightly over $10 billion US. And here we are now with the Hong Kong implied market cap at just over 2 billion. And largely the reason for that, of course, would have been the fall in the China spot price mostly of carbonate. Hydroxide was more resilient. And during 2018, Ganfeng's production mix has been far more skewed to carbonates. The expectations are around 40,000 tons, including the expansion, and hydroxide only at 28. So what we saw was a big fall in their main product line, but at the same time, the original contracts that they agreed with Mount Marion for offtake, certainly the portion that wasn't theirs, was tied more to rest of world prices that proved far more resilient, certainly on the contract side, than the Chinese spot market. So you had the worst of all worlds. You had a falling sale price and you had a tightening margin, and both effects certainly played out in the Q3 results, and the market was brutal. And then, of course, the Hong Kong listing, they had to get it away. They only ended up raising $400 million at a hefty discount to the Shenzhen price at the time. So post the Hong Kong listing, I'm sure that given the low take-up price, that also weighed heavily on the Shenzhen listed price.
The lower spodumene prices combined with the higher volumes, importantly as well, hydroxide volumes, and to export markets, to LG Chem and Tesla, their offtake partners, those are things you're highlighting are going to translate into a more upbeat 2019 and 2020. Is that correct?
Yes, absolutely. So what you're going to see now is what my understanding is in the pricing mix going forward now for their new spodumene contract offtake agreements is, I've estimated about 65% of it will be tied to the China X-Works carbonate price, spot price, and then 30% rest of world's battery grade carbonate price, and then a tiny 5% China lithium hydroxide spot price. So you're going to see a far more hedged production side from carbonate, but you're going to see an enormously leveraged operational leverage on the hydroxide side because your feed price is coming in linked to carbonate and a lot of it domestic pricing, whereas Ganfeng is going to probably export something in the region of 60 to 70% of their hydroxide output and going to be achieving, who knows, but at the moment we're looking at about a $4,000 spread between hydroxide to carbonate. So it's going to really flow through just from an operating margin perspective. And then, of course, their capacity growth is phenomenal. We're looking at growing to something like 93,500 tons, up from 31,000 in 2017. So literally a tripling in capacity. Granted, they won't have quite ramped up all of those, by the end of 2020, but still an exceptional growth path.
That's a huge growth path, and we're only talking about conversion of hard rock here. We're not talking about brines, and this is something that Ganfeng is seriously experienced with. That said, these are very big plants, 20,000, 17,500, I think coming on stream are much larger than the 5,000 and 8,000 tonners, but I'm confident they will execute pretty well. You're suggesting that a multiple of 9 to 10 on Ganfeng compared to kind of 5 or 6 where it's trading, you think that's the reasonable?
Yeah, I do, Howard. I think that it's only fair that, obviously, given the fact that they are not a vertically integrated producer from the spodumene side, other than obviously their share of the Mount Marion project, is they have an exceptional volume growth offset by slightly lower margins to the other vertically integrated producers. So I think they balance each other out. So that 9 to 10 is really bringing them in line with where the other major producers are currently trading. If we see a rally in lithium shares, then it's quite conceivable that they could all move up. But for now, I think they deserve a parity rating, given that their volume growth, offsets, to my mind, adequately a slightly lower margin. But those margins, as I've mentioned, are now pretty well hedged against the spodumene contract offtake agreements that now, far better reflect Ganfeng's exposure.
All right, that sounds good. I'll revisit that question on multiple. I think a little bit differently. I don't know that we should have parity, but I'll go into that subsequently. Just a couple more questions. Where do you think SC6 prices need to go for Chinese converters to make a reasonable margin?
In the report that I've just released, I've put a table in there. I think, the question is, I guess it can be argued, is what is a reasonable margin? Because if you have a look at another table I've included in my report, the capital intensity per ton, even in China, varies considerably. So you have some operators, that's not fair, but there is a disparity between operators. So to put a fixed margin across the entire industry won't necessarily fairly reflect what some people need to earn in order to pay back the capital and survive. But that's the beauty of Ganfeng. They're at the absolute lower end, certainly in the hydroxide. But if we assume 10 to 20% is a reasonable margin, and we are looking at 11 to 12,000 as the China spot price for lithium carbonate battery grade, including VAT, then you kind of need to be somewhere in the $700 a ton range. So I noticed the most recent pricing guidance coming out of, I think it was Fast Markets, was $675. So it looks as if the average spodumene price, it's arguable, of course, whether that's all 6%, but assuming 6%, $11,000 to $12,000 a ton, you need around 700. If spot prices are going to drop below that, we could be seeing a move closer to 600, which you and I have had the conversation. There are a lot of spodumene producers that are still ramping up with high strip ratios and high costs. How they'll be able to cope with a $600 sale price when their costs for some of them are around that level could get interesting.
Okay, appreciate that. Finally, what do you see as the key risks to Ganfeng?
I think the key risks on Ganfeng is, well, I would say risk, but why they wouldn't be as attractive from an investor standpoint is realistically, Hong Kong is the only listing that foreign investors would participate in. That only issued 200 million shares at $2 a share. That's now dropped, so we're talking in the 300 millions as a market cap. So pretty illiquid, and some of the original takers won't sell, so free float is small. The ability, with capital controls in China, I don't know, does it now mean that Hong Kong is the only vehicle by which Ganfeng can grow, in which case they are going to have to execute perfectly and grow organically and, cheaply with their cost of capex, but it might be limiting. And the question is, if there are any floor prices in the spodumene contract offtake agreements and China spot price drops and they're forced to pay a minimum, that could put their operating margins under pressure. And we're back. Howard, I really enjoyed your piece on Livent. Why don't you give us a bit of a valuation commentary?
Well, thanks. Yeah, we'll speak about Livent a bit later, but you made a comment that you thought parity it should be possible with Ganfeng to, let's say, their peers, Livent and Albemarle, and I would argue that Ganfeng will almost always trade at a discount if you're using a Western investor's mind. For corporate transparency, corporate governance, and other issues, non-emerging market, et cetera, but also because they're going to have lower margins. They're not vertically integrated. I think steady state, I saw the consensus forecast is maybe 25 to 30% margins, whereas Albemarle and Livent will be, in the 40s. So it's interesting that Livent and Ganfeng have nearly identical market caps today, despite Ganfeng having nearly twice the sales and twice the expected forecast sales in the 2019-2020 period. Ganfeng, the most important thing behind the multiple, in my opinion, is not is this a specialty chemical or a commodity chemical, but is there certainty and predictability of and quality in their earnings. And in Livent and Albemarle's case, because they have long-term contracts, fixed price, I think there's more predictability, whereas Ganfeng has more variability in their input prices, and also, if you look at their offtake with LG Chem, it's based on quarterly pricing, so they have a more volatile sale price. So greater volatility translates into less predictability and therefore somewhat lower quality earnings and therefore lower multiple. I also take your point on the trading liquidity and corporate transparency. Absolutely, $300 million of free float, of which half was taken by their cornerstone investors, which included some state-owned enterprises as well as Samsung and LG Chem. There's just not a lot of float. In America, a Joe Battery Pack investor investing in the Hong Kong listing of Ganfeng could only, there's $2 million of trading volume per day. The question is, what should a steady state discount be? I think 25 to 30%, where it is today, is reasonable. I think 40 to 50% would be too much. I think it's possible that that could narrow to 15 or 20%, and in some cases, it actually may trade at a premium. There are times when the Chinese retail investor or the Hong Kong investor gets giddy for equities, as they did in 2015 and 2016, and it's risk on again. You can't rule that out, and in that case, the tight liquidity, free float, works to your benefit, because there could just be a pile into that. But absent, some bubble-like risk-on mentality, steady state, I think Ganfeng, if you're a institutional hedge fund in New York, you're likely to trade Livent at a premium and Albemarle at a premium. On an absolute basis, so that's a relative basis commentary, on an absolute basis, I wrote in the Lithium Bowl, is this industry a specialty chemical or a commodity chemical? And as I said, that's less relevant. However much Albemarle and Livent talk about everything being different, it all comes down to predictability, certainty, quality of the earnings. And it is possible that the market, just ratcheted down these multiples from when they priced the Livent IPO. They said it should trade at a 12 times multiple. And then December, everything got marked down, and now it's trading at 10 or maybe below that. So has that philosophy changed? I've been walking around for 3 years looking at this Rockwood and Tangshi bidding for Talazin at 14 times EV to EBITDA, and then Albemarle for Rockwood paid 17 times EV to EBITDA, saying that lithium's a great business because they trade at these high multiples. Reinforcing that high multiple mentality is the Albemarle for Mineral Resources transaction. This makes me quite optimistic that companies of strategic value to a lithium oligopolist will, in a competitive bidding process, will continue to get those very high multiples. And as we look at Mr. Market Scoreboard and early stage companies and mid-stage companies, trying to find those with attributes that could attract, the oligopoly are likely to garner, premium valuations.
Howard, it seems that Livent spinning out of FMC has had a very busy time. You want to just take us through that timeline?
Yes, in early October, actually, there were back-to-back IPOs. Ganfeng was October 4th and Livent October 10th. I labeled this kind of, rocky. It looks like both of them were very battered and bruised after that, and it was kind of a split decision. Although most people watching the original Rocky thought Rocky won. The book build, if you just go back there, was an $8 to $20 range, but they ended up pricing it at 17. Ganfeng's range was much wider, from 16.5 to 26.5, and was priced at the bottom. I've called Livent, the real thing, comparing it to Coke and, certain branding genius. I know there was some commentary about the name that they picked, Livent, and a Canadian company that went bankrupt. But overall, I look at them as Coke. They have a 60-year history. They spun out of a 183-year-old company. Their history traces back to North Carolina when they were producing hydroxide and carbonate from spodumene pegmatites there. It surprised me and many others, but according to the IPO prospectus using Roskill data, that Livent is the lowest cost producer of both carbonate and hydroxide. I was surprised to have seen that. I've called this spin out Philadelphia Freedom. They're based in Philadelphia. 15% has now been spun off. They're on schedule for a full kind of declaration of independence on March 1st, when 100%. So the company will have $2 billion thereabouts of freely floating pure play lithium shares. They argue, Paul Graves, their CEO, again, going back to this Declaration of Independence, we hold these truths to be self-evident. Not all lithium is created equal. And that's something that they emphasize greatly. They are a hydroxide and lithium metal leader, as well as many other lithium compounds like butyl lithium. They have a very strong balance sheet, zero debt, although they have a $400 credit line from Citibank. They already have 10 sell-side analysts covering them, 5 or 6 from the syndicate and 4 or 5, outside of the syndicate. They talk about their contracts, their pricing that have certainty, predictability. Again, going back to multiple conversation, I just think that they're fully integrated. They have a single asset. 100% of their focus is there. And because of they're having their customers help underwrite their growth strategy, I'm confident they will have, mid-40s margins with much less volatility over the next couple of years' growth.
And tell me, Howard, do you think their strategy is a house of cards? Should they focus on chloride and carbonate?
Yeah, I know some have argued for that, and they do make a good carbonate, they do make a good chloride, and chloride does go into metal, and metal is the holy grail, for solid state. But look, I'm not one to question their strategy. They're consuming most of their carbonate internally. I think something like 88 or 85% is going into hydroxide, and their margins are 45 to 47%. So that's nothing to sneeze at. So They are somewhat short carbonates. If you look at their growth strategy in the next short while, they're going to grow their carbonate, I think, to 60,000 tons, and their hydroxide to 55,000 tons, longer term. But in the short term, I think in the next couple of years, their carbonate won't be, as great. They do have, the one relationship they have is with Nemaska. I understand that needs to be renegotiated, and we're waiting to hear on that. But I don't think it's a house of cards. I think they know what they're doing. I think 20 years they've gotten it right. And, but going forward, the industry is growing very rapidly, and brines are slow to ramp. So a real question will be, going forward, is what do they do beyond, Argentina? And we could talk about it in a second, but I would say also their capital intensity is not small. You were commenting on Ganfeng. It's insanely low capital intensity to build hydroxide and carbonate plants in China. So Livent, if you look at their capex, are similar to some of the other brines that are being constructed. Lithium Americas, and you look at some of the definitive feasibility studies. It is expensive. That said, the vertical integration enables them to have, higher operating margins and, long-term, the lower OPEX, higher cash flows is that trade-off.
And what are the future?
Yeah, one of the risks is just having a single asset in any country, and then a single asset in Argentina is, there is some risk. The benefit of it is, unlike Albemarle or Ganfeng, which has so many operations in multiple locations, they just need to focus one place here, and because it's a proven process, they're saying there's no design risk, no technology risk, they're just replicating, so that's good. But I would expect, especially given the change in narrative to, hydroxide being cheaper from hard rock, that there being a hydroxide leader, they may look to a hard rock in other, better sovereign jurisdictions over time. And I think they're in a very good position to do that. The question is, will they pursue a Ganfeng-like strategy, like they did with Nemaska, being an offtake party of, first resort? Or might they go the route of an SQM, KDR, Kidman, and use their hydroxide expertise and take significant equity stakes and build refineries and the like in mines and refineries? Or might they go whole hog and buy entire mines and build their own hydroxide facilities? I think it's to be seen. I think they're focused on the full spin out, and over the course of 2019 and more likely 2020, 2021, you'll probably see them as a prospective partner, acquirer, and conceivably they could get acquired themselves. That is another thing going into a multiple conversation. Compared to Ganfeng, Ganfeng could be acquired, but I think it's less likely than, let's say, Livent would be. Welcome, Guy Bourassa, CEO of Nemaska Lithium, who has won the award of being the first ever Lithium-ion Rocks guest. Rodney is going to start the questioning.
Looking at the cash that you raised last year and the use of proceeds and your latest update released in October, is it fair to say that Nemaska won't need to come to the market for any further capital this year?
Well, the way we finance the 1.1 billion Canadian raise, we're expecting not to have to go back to the market when we raised it. Currently, we still have $75 million US available from the second tranche of the streaming agreement that we expect to be drawing around June of 2019. Thereafter, we still have in escrow $350 million US from the secured bond that we issued. We have to spend all of the equity we raised plus the full $150 million streaming money before we are able to draw from the bonds. To draw from the bonds, we will have to complete a cost-to-complete test certified by an independent engineer for the trustee, for the bondholders. So therefore, depending where we are with the with the budget and evolution of the construction, we might or might not have to go back to the market before being able to draw from the bonds.
Are things all still on track and on budget?
The mine is scheduled to be completed October 16, 2019, and we're still talking about end of August of 2020 for the hydrochemical plant. So we do expect by the end of February to be able to give an update as where we are as of January 31st and how we see the budget evolving for the whole project.
Okay, great. And your long-term cost of production for the spodumene is low in the feasibility. But can you give us any guidance as to what that cost is likely to be as you ramp up and commission production from Q3 this year and sell to General Lithium through Hanwha before the Shawinigan plant is ready?
We have the 25, 27 months offtake agreements with General Lithium starting at the end of 2019. All that the spodumene that we're going to be producing while commissioning, ramping up, and once in full production, that will not be needed until we're fully commissioned and ramping up into the electrochemical plant in 2020, 2021, is already sold to General Lithium, like you mentioned. We, in the feasibility study, delivered to Shawinigan the spodumene 6.25% Li2O is expected to be costing about $257 US during commissioning and ramp up. You're not at your full volume, so the price is going to be a little higher, but we do expect to have a good control on the cost structure.
And what's the cost from that port to China?
$75 to $100 US.
So, Guy, what are your thoughts on lithium prices and the price spread between hydroxide and carbonate?
The spot price of lithium carbonate in China have realigned. We're seeing now currently $10,500 to $12,000 US. And I don't believe that in the future we're going to see it going much lower than that because of the actual cost structure and chain of supply of lithium salts around the world. About 50% of the world supply comes from China. And China is dependent on importing raw material, mostly importing raw material from Australia, from third parties. That comes with a cost, obviously, because there's an export tax in Australia, an import tax in China. Of course, profit taken by the producer in Australia. Landed price, CIF China, of 6% concentrate at a minimum of $500 US. We hear it's currently from third parties around the 600. Production cost of carbonate in China, all in, would not be much lower than about $9,000 US. So at that production cost, I don't see anybody in China wanting to sell its carbonate lower than the $10,500 to $12,000. There's always been a premium for hydroxide over carbonate in the past, mainly because hydroxide was coming mainly from brine producers, and they have the added cost from carbonate to hydroxide because they need to do a further conversion. They still have a $1,000 to $2,000 added cost, so representing what people on the market calls a premium. And I do believe it's going to remain like this for a while because a lot of people talk about the fact that hydroxide is not going to be produced by spodumene, so directly from spodumene, having it about the same cost of production as carbonate. But in reality, even if the Chinese start to increase their production of hydroxide and try to make it directly, quality and homogeneity of production will remain a very big challenge for them and for the OEM battery manufacturers and car manufacturers outside of China. People have to understand that there's a big difference in quality and specification for a Chinese domestic market using raw material raw material, lithium carbonate or lithium hydroxide for their own internal need versus what the rest of the world wants or can accept. We have to remember that all of the increase of the demand comes from electric cars manufacturers. And electric car manufacturers, like any car manufacturers, need to give a guarantee on their product, and they're guaranteeing the batteries. So obviously they cannot, absolutely not afford to have material that is not of highest quality, highest purity. And currently the hydroxide, Chinese hydroxide, does not meet that criteria for very serious outside of China car manufacturers.
That's an interesting point that you've been making, Rodney. You question the quality in China versus Korea and Japan.
The problem in China in general, and I'm not referring specifically either to Tianqi or Ganfeng, the commissioning and being able to get it to spec and maintain the specs. Traditionally in China, they were, and most of them are still working in batches. Therefore, from one lot of production to the other lot of production, you may have significant variation in the impurities level. So it's a big challenge, and that's one of the things, of course, the Chinese want to export, and I know that Ganfeng is doing so. I know that Tianqi is doing so, and I know that some of them do not meet the standards and that are still in the qualification period.
Last check at the company, you had about 90% of production secured with offtakes. Is that still the case?
Yeah, we have, strictly talking, 74% roughly that is under contract, committed contract. And we have a right of first offer for 20% in favor of Softbank. So that's why we say that we have a 94% that is committed. So we do expect, and we've been informed by Softbank of their very intention to take that 20%. So that's why we can say that we have over 90% of our capacity committed currently.
If my memory serves, Orion will pay you 40% of sales proceeds to receive 14.5% of total production, subject to a 5,000-ton cap. Is there a floor price or value for Orion's 40%, or can that number go as low as prices go?
It is directly linked to the actual sales that we're going to be making, so it has no floor.
Have you had any feedback from other investors as to why the share would trade at such a low price to net present value this close to production?
The bad market in general for lithium, the new innovative process, and skepticism in general in any construction project.
When the full financing was done, I wrote in the Lithium Bold, I think June of last year, Rockin in the free world, which is a Neil Young, a Canadian Neil Young, and you're a Canadian company. And but the free world was, you have very specifically seemed to have taken a non-China approach to your financing. However, when I was reading the red herring of Tianqi, I was reminded that they have a small investment in Nemaska. So could you just describe that history of Tianqi in China and why you have seem to have consciously, made a non-China approach, with the exception of selling the spodumene, through General Lithium?
Sure, absolutely. The Tianqi story is a very interesting and long one, so we'll try to cut it short. But I was fortunate enough to meet Mr. Yang and Vivian Yi in July of 2010. And when I was looking in China for potential offtake clients, initially trying to develop the spodumene project, they have been a very good shareholder with us, good investor. At some point, they owned close to 20% of the company. In October of 2012, when we released our initial PEA, they told me that they would be backing the whole financing and that we didn't need to look for anything else. They were definitively very supportive of our project. Unfortunately for us, And maybe, fortunately for them, they had to overbid Rockwood in the acquisition of Talison. So according to the different financing they had to do that, they were forbidden from or restricted from any further lithium investment while they were indebted to CIC. So they stopped investing in us. They have not sold one single share that they acquired in 2011. Now they own maybe about 2.5%, but it's a matter of dilution since they did not invest after 2011 because of the Talison acquisition. So it's not. I wouldn't say it's not fair to say that we purposely decided not to go with Chinese investment in the last round of financing. We've been approached in 2016, 2017 by a very large number of different Chinese companies interested, be it car manufacturers, battery manufacturers, other players in that lithium sector in China. And the issue rapidly became obvious that you could not make a deal with a Chinese company that had no money already outside of China. So it was a very much too long process to freeze the project, hoping that the Chinese would come with an agreed investment outside of China and that you could close. And we were talking projects of 9 to 12 months. And the reality is that to be able to obtain the authorization from the Chinese government to get the money out in a project, you needed to lock your project with them, so have a final binding agreement. So we decided that it was not worth the effort and the risk, mostly the risk, to stop the whole project for maybe a year, and with the risk at the end of not seeing the money or not getting the final authorization by the Chinese government. There's no need, honestly, no need for us to sell material to China. There's so much demand coming for high purity lithium hydroxide around the world outside of China that we leave the Chinese producers and the Australian provider of spodumene concentrate in the Chinese domestic market. We're only going to be producing roughly 36,000 tons of lithium hydroxide per year. But 36,000 tons is barely 25% of the annual requirement simply for Volkswagen. So you see that there's a lot of other clients that need material that are not in China, that are closer to us, and that's what we're targeting. And that's exactly what we have in the actual agreements, offtake agreements that we've signed.
And Guy, one final question for now is, you just had some meetings in New York. What's the feedback you've been getting from the investors?
They're still very keen on the prospect of the lithium market. Everybody is, I think, is waiting on the next milestones or news coming, the quarterly calls from the real producers to confirm the sales price and the increase in the demand or the sales. Long term and mid term, I have not heard any negative on the prospect of lithium. Absolutely not.
They're saying podcasting now is like the early days of radio. And Casey Kasem, I don't know if you had heard
I
this.
remember him.
You remember him, like America's Top
did.
40? One of the famous segments on America's Top 40 was, at the end of the program, a long-distance dedication. I'd like to give a long-distance dedication to a black dog in the Tar Heel state. You may recall that Led Zeppelin's among my favorite bands, and there's a very special song with your name on it, Black Dog, which I think is appropriate as the year of the dog is now over and it is now the year of the pig. respective LinkedIn and Twitter posts, Rodney and I may share with our audience some rationale for a stock for which we have conviction, to own or not to own. If you agree or disagree with and act on or against the rationale of anything said or written in this or any other lithium-ion rocks or lithium-ion bull, that's your free choice. But to be clear, what you are listening to or reading is not investment advice and may not be unbiased. It should not be construed as an investment recommendation to buy or sell any security. Rodney and I are not registered investment advisors nor broker-dealers. Please visit libull.com for further disclaimers.